board. Parag Thakkar is with us, Senior Fund Manager at Fort Capital. Parag, good morning. Great to have you with us here. Thanks for joining in. We'll talk about some of the news flow that we're waking up to this morning, but I wanted to start with asking you about Groww and whether you took a bite, post-listing. Opened at 112 and 170 or so, 170, 180 yesterday. What do you make of it? And have you looked at the numbers?
So I think these are all, any businesses which become tech-enabled has operating leverage, and of course the ROICs are also infinite in some cases. So these businesses get huge premiums, but I'm not happy paying such a high valuations to these businesses because I have a firm belief that any business cannot sustain growth of more than 30-40% forever. And so you should not pay more than 50-60 times for any particular business, and such high market caps also. For example, many companies in this business are trading at half of this market cap, and these are age-old companies which we know. So I would say that I would refrain from buying into this momentum, and for that matter, any other tech-enabled businesses.
But is the valuation really so? I mean, that's why I asked you. Have you looked at because I was looking at it, right? 18, and we'll put out that link as well with our research team. So some 1850 crores in profits in FY25, and they're saying they'll grow between 25 and 30%, right? So which is what you also said. So there's earnings visibility. I mean, based on if you just do an Excel projection, it should be 3,500 crores of net profits in FY28. So it's about 30 times, right? I mean,
unfortunately, life does not work on Excel sheets.
No, I know that was coming, Parag, but I mean, you got a project, right? I mean, if you're looking at...
So basically, see, we are happy making money in our old regional banks kind of names, which have...
Yeah, no, that's fine. You can participate in what you like, but is valuation... I mean, I heard a lot of general commentary that it's 50 times, 60 times, 70 times. The numbers don't say sort of point to that. That's all I'm saying.
Yeah, that is true. No, but I'm saying market caps are also very high now.
Yeah.
If you compare it with any other traditional broking firms and all, the market caps are also too high. So for this kind of things, so it is much better than the I would say loss-making companies which have come out with IPOs and which are also getting equal or more market caps. It is much better than that. That I should have agreed, but I would say that. We don't feel all this is very sustainable, and that is why we stay away from it. Might be we don't understand them too much. It is a question of circle of competence also. They might be doing well. They might be great businesses. They might keep doing well. But I would say that it is a question of circle of competence also.
One general comment across for all these new listings, right, is that the first 1 month is kind of sometimes a little artificial because there's not too much supply, right? That lock-in, etc. So it's not about growth. It's generally true across the board. So real price discovery, I guess, happens after all these lock-ins end, Parag, right?
Yeah, correct. And that is also true, and there is a lot of momentum right now. Markets are anything which is tech-enabled actually gets huge premium to the conventional businesses, which also might, by the way, uses technology. But these are purely set up after this technology revolution has come in. So these are getting huge premiums.
By the way, you'll have more to discuss and debate, Prashant, on Friday. Groww reports numbers on Friday.
Oh, lovely.
It will be one of the most eagerly awaited, events of the day. So that's your date to figure out if that...
But I think as Parag said, right, these are tech-enabled, right?
Yeah.
Business, it's an extreme... He used the word infinite ROC. I mean, because, you look at the unlisted Zerodha, right? And it's just the same team, the same number of people. You just have to invest in tech. I'm not saying it's a simple business, but the point is you don't have to put more money in to acquire customers. And it's network effect as well. So Groww I think that who was pointing out that they've started a slew of businesses apart from broking.
Absolutely.
And all that will...
Mutual fund sales, loan against shares, etc. And look, I mean, everybody can get technology, right? And a lot of the incumbents also, the larger, and they come from much larger financial conglomerates, right? It's easy to get technology, but surely something players like Groww and Zerodha have done right to become the largest brokers of the country.
I'll tell you, I was watching this...
Starting way late. I mean, they came in the 2000s, right? Not even later. Post 2010, and we have established.
So I'll give you a global example, something similar. Actually, even more startling. There's a company called Cursor, right? It's now hit $1 billion in annualized revenues. $1 billion. You know how old the company is? 3 years.
Wow.
They've raised money at $29 billion valuation. Guess how many salespeople they have? 3.
This is scary.
So, they were asked, how did you start, right? They said, we just opened a Stripe account. And that's it. I mean,
Power of technology and the power of disruption. It's real. It's very, very real. Thakkar, Parag, Westlife Food. So Mr. Jatia bought some shares from the market. Not too much. I think just about 8,000 shares. But as far as Q2 goes, the performance was still sluggish. I'm just checking the numbers again. Same-store sales growth still in contraction territory. I think a little over 2% down year on year. What's your sense? Do you like anything in this space, Westlife or otherwise?
No, QSR space, see, after long, I would say 2-3 years of sluggishness might come out of because overall consumption has picked up after the GST cut in the festive season. So I would say that this is a good sector to watch. Up till now, we have not bought anything. We saw good results from Jubilant Foods and stock also reacted positively to it. So we will look into this space. It looks interesting. It had offered a long, I would say, 4-5 years ago, everybody was bullish on this thing, but then earnings never came. And so everybody gave up. So this is a good time to look at this space, in my view. And coming back to this Morgan Stanley note, I would agree with 2 things highlighted over there. One is in India, I don't see any big risk because India's macros were absolutely brilliant. And one big macro factor which everybody forgets is corporate debt to GDP. India's corporate debt to GDP is so low, it is at 56%. And Indian corporates are under leveraged and banking balance sheets are absolutely strong. So apart from current account deficit, fiscal deficit and inflation, these are the 2 big macro positives for India. And now, finally, we are seeing a double-digit earning growth coming in. Q2 results were very positive. I would like to highlight some of them. For example, SBI increased its credit growth guidance from now to 12 to 14%. With a credit cost of only below 50 bips. So I would say that L&T, for example, the best indicator of private sector capex or capex cycle, L&T is one order of around 1,15,000 crore in Q2, which was highest ever. They are sitting on 6.67 lakh crore order book. Mahindra has increased its tractor volume growth guidance. Escorts has also increased its tractor growth guidance. Reliance has delivered 16% revenue growth in Q2 and Q3 it will accelerate in retail. So I would say that all broad factors which you see, I feel from Indian economy perspective are improving. So the only risk which can come is from outside. Suppose if US market corrects 15-20% due to this AI thing or something else, then of course we will also correct. But I would say that I would agree with 2 parts. One is banking and industrials will do well. And second is that any risk which can come from global side. On India perspective, I would say that once the trade tariff deal is signed and we get a tariff which is below 20%, I don't see any risk come from the Indian perspective.
Okay, all right. Parag, final question before we let you go. The outperforming sector or the comeback stock of this month has been Asian Paints. Nomura, they had turned the corner at the start of the month and that worked very, very well. In fact, I had the author of that report, Mr. Mihir Shah, who had joined in yesterday on Finding Alpha. And he says there's more to go because the street is still very negative. He believes that the disruption wasn't as big as expected. The healthy competition is likely to continue, but it won't be disruptive. What is your view on Asian Paints as well as Berger Paints? A rank underperforming for the last 2 years. Now it seems competition seems to be evening out a little bit and these guys are making a comeback. Your take?
Yeah, I would agree to that because whatever competition had to do. And this is not a geo kind of business, right? Where you have a fixed expense of spectrum. And so, because ultimately Birla Opus will also have to buy same raw material which Asian Paints have to buy, right? So it was my view earlier also that this space cannot be disrupted for long term. It can be disrupted for 1 or 1.5 years. And so we also bought Asian Paints at 2,200. Of course, we booked profits also. But I would say that, and plus we are nearing a fair. So festive season was there. Now wedding season is going to come. So from near-term perspective also and from long-term perspective also, I would agree with that view.